Imagine a small snowball at the top of a hill, barely anything in your hand, and then you let it roll and watch as each turn packs on more snow so the ball grows faster the longer it moves. That's exactly how compounding works with money. Your earnings create new earnings, and the base that's growing gets larger as time passes. When you leave interest, dividends, and gains in the game instead of pulling them out, you turn one push into momentum that does most of the work for you. Today is about unlocking that momentum so you can start small now and let time do what perfect later never does. By the end, you'll have a simple plan to start your snowball and a clear preview of the next video where compounding is shown with simple numbers anyone can follow. At the heart of this is the difference between simple interest and compound interest, which sound similar but behave very differently over time. Simple interest pays earnings only on your original principal, which grows in a straight, predictable line. Compound interest pays on your principal plus all prior earnings you've kept invested, so your growth base keeps getting bigger and the curve starts to bend upward. That bend is the magic, because the more periods your money compounds, the more dramatic the difference becomes versus simple interest. Compounding frequency matters too, daily, monthly, quarterly, or annually, because the more often earnings are added back, the more chances your base has to grow. In plain language, compounding is earnings on earnings, and the longer it runs without interruption, the more surprising the results become. Think back to that snowball on the hill and picture each flake that sticks as a dividend, an interest payment, or a reinvested gain that adds to the mass. The first shove is the hardest because you're overcoming inertia, but once the ball is rolling, consistency and time do the heavy lifting. That's why reinvesting matters so much. If you skim off the snow after every turn, you don't just slow the ball, you shrink the very base that makes the next turn more powerful. The solution is to make reinvestment automatic whenever possible, so the snow keeps packing on without asking you to decide every month. Time is the growth lever you cannot buy back later, which is why $1 contributed today can be more valuable than a larger dollar contributed tomorrow. In finance, this is called the time value of money. Money available now can be put to work and earn returns over more periods than money available later. Waiting costs you compounding periods that cannot be recovered because each missed period is a chance for growth on top of growth that never occurs. Meanwhile, inflation quietly raises the hurdle your future dollars must clear just to maintain purchasing power, which is another reason to make time your ally. You don't need to time the market to benefit from time in the market. You need a schedule that keeps you investing through good days and bad. This is why starting today usually beats starting big tomorrow. The calendar can do more for you than a dramatic contribution that shows up late. A small, consistent deposit that begins now has more compounding periods to work with, which often outweighs the effect of a larger deposit made years from now. Automation helps because it removes the monthly decision and the temptation to wait for the perfect entry, which rarely arrives on cue. Think of it as getting the snowball moving immediately and trusting that size follows motion when the hill is long enough. Reinvesting earnings is how you keep every flake in the snowball, and there are easy tools that do this without effort once you set them. A dividend reinvestment plan, often called a DRIP, takes the cash dividend paid by a stock or fund and automatically buys more shares for you, typically without extra commissions. Most retirement plans and brokerages let you elect automatic reinvestment for dividends and interest so that nothing sits idle, earning nothing. Cashing out those distributions interrupts compounding and shrinks your growth base, just like scraping snow off your rolling snowball before the next turn. In North America, the accounts you choose act like wrappers around your investments, and the wrapper can boost or drag on your compounding depending on taxes and plan rules. Employer-sponsored 401k plans allow contributions directly from your paycheck, often with an employer match that is essentially an instant return on your contribution. Many plans offer both traditional 401k and Roth 401k options, giving you the choice between tax-deferred growth or tax-free qualified withdrawals in the future. Outside of the workplace, individual retirement accounts, traditional and Roth IRAs, provide tax-advantaged compounding based on your eligibility and tax situation. A Roth IRA in particular grows tax-free with qualified withdrawals in retirement because you contribute after-tax dollars at the start. Health savings accounts can be uniquely powerful since contributions can be tax-deductible, growth is tax-free, and qualified medical withdrawals are tax-free, creating a triple advantage when used properly. For education goals, 529 plans offer tax-advantaged growth when used for qualified education expenses, helping your education snowball roll with less tax friction. Inside those wrappers, you need growth engines that naturally produce earnings you can reinvest, and many investors rely on diversified index funds, bonds, and dividend-paying stocks. Index funds distribute dividends and interest that can be set to automatically buy more shares, reinforcing compounding across a broad market exposure. Dividend-paying equities can be enrolled in DRIPs so that each payout adds incremental ownership without waiting on manual orders. Diversification across assets helps keep your snowball intact during market storms, allowing reinvestment to continue even when one area stumbles. You don't need complex math to build conviction that compounding works, but a couple of mental tools help you feel the curve instead of just hearing about it. One popular shortcut is the rule of 7,272, which estimates how many years it takes to double money by dividing 7,272 by an assumed steady annual return. The goal isn't precision, but intuition that consistent, reinvested returns bend the line upward over time. If you want to visualize scenarios more concretely, use a reputable compound interest calculator to plug in small monthly contributions and see the long arc. Keep in mind that markets vary and no calculator can predict the future, but the principle of reinvestment plus time does the heavy lifting. Behavior is the other engine, and automation gives you a quiet edge by making the right choice the default. Payroll deferrals into a 401k mean you invest before the money hits your checking account, which reduces the chance that short-term demands crowd out long-term goals. Automatic transfers into an IRA or brokerage on a set date keep your cadence steady and create more periods for earnings to reinvest. Enabling dividends and interest to auto-reinvest prevents small amounts of cash from pooling and losing time in the market. Over long horizons, small, relentless contributions often outperform sporadic, larger lump sums that depend on perfect timing to match the outcome. There's also a hidden cost to delay that's easy to overlook. Every month you wait is one fewer compounding period, and periods are the oxygen of the snowball. The contributions you make earliest have the longest runway to influence your future results, which is why start tiny now beats start huge later so often. A practical way to begin is to set a minimal viable contribution, an amount you won't feel much, just to get the clock started. If you receive a windfall, treat it as extra fuel, but don't rely on windfalls to substitute for the streak you began today. Compounding can work against you too, which is why high-interest debt is like an anti-snowball pushing uphill the other way. Credit cards typically compute interest using a daily periodic rate applied to your average daily balance, which means costs can rack up quickly if a balance carries. Prioritizing high APR balances for payoff is often the highest return, lowest risk move you can make because it stops negative compounding from eroding your future growth. Automating payments above the minimum helps reduce principal faster and cut the number of periods where interest can accrue. Killing the anti-snowball frees your cash flow so your investment snowball can roll longer and smoother, Taxes, fees, and inflation are like friction on the slope, and the less friction you have, the farther your snowball can travel. Tax-deferred accounts like traditional 401(k)s and IRAs keep more of your money working each year by postponing taxes until withdrawal, which can magnify compounding. Roth accounts flip the script by taxing contributions now and allowing tax-free qualified withdrawals later, which can be powerful if rates rise or your horizon is long. HSAs offer that triple tax advantage for qualified medical spending, giving you one of the most efficient compounding vehicles available when used correctly. With 529 plans, Growth is tax advantaged for qualified education expenses, helping your education dollars go further over time. Fees reduce the base that compounds, so choosing low-cost funds and nudging down expense ratios where possible is a quiet but meaningful performance boost. Inflation never sleeps, so part of the mission is aiming for a growth rate that outpaces it over the long run, acknowledging that real purchasing power is what ultimately matters. A steady investing cadence, often called dollar cost averaging, buys more shares when prices are lower and fewer when prices are higher, while keeping you consistently invested. Pairing that cadence with automatic reinvestment of distributions stitches together more compounding periods with fewer behavioral detours. DCA is not a guarantee of better returns, but it is a useful behavioral system for staying in the game long enough for compounding to matter. Over years, the combination of cadence, reinvestment, and time tends to produce outcomes that feel disproportionate to the size of each individual deposit. Set simple milestones to lock in momentum, because progress you can see sustains habits you can keep. If you have a 401k, aim to capture the full employer match as a first checkpoint, because that's free leverage for your snowball. Turn on dividend and interest reinvestment across accounts so you never miss a period due to idle cash accumulation. Review contribution rates, fees, and allocation annually to trim friction and ensure your plan still matches your timeline and goals. Keep a modest emergency fund so a surprise expense doesn't force you to interrupt compounding or take on high-interest debt that fights your progress. Here's a straightforward way to start your snowball today. Take 5 minutes with a trustworthy compound interest calculator and enter a small monthly contribution, a reasonable horizon, and the reinvestment assumption to see a long-run picture. If you have access to a 401k, set a payroll deferral now, however small, to begin capturing compounding periods, and add the match target as your next step. If eligible and appropriate, schedule an automatic monthly transfer into an IRA to extend your tax advantage compounding beyond workplace limits. In every account, toggle dividends and interest to auto reinvest, so every distribution is drafted back into the snowball without delay. Put a quarterly calendar reminder to nudge contributions upward, check fees, and confirm that your emergency cash buffer is intact. If you carry high-interest credit card balances, set an automatic payment plan that accelerates principal reduction to neutralize negative compounding as quickly as possible. Everything from here on this channel will reference the same core engine, reinvestment plus time. Whenever a new tactic appears, asset selection, tax strategy, or risk management, the question will be the same. Does this increase the base that compounds or the frequency with which gains are reinvested? When in doubt, choose the path that makes it easier to stay invested and keep earnings working, because consistency beats intensity in wealth building. Think of every decision as either packing on snow or scraping it off, and choose accordingly. Before wrapping, here's the next step in the series and a reason to stick around. The very next video walks through compounding in practice with clear, simple numbers so you can see exactly how tiny, steady moves add up over time. Bring a number you care about, a monthly contribution, a time horizon, or a target, and follow along to model it with a calculator in minutes. Subscribe and turn on notifications so you don't miss the breakdown, and get ready to watch your snowball go from abstract idea to concrete plan you can execute today.